Hi everyone and welcome to another episode of The Naive Investor. Today we will be looking at where the big money is going. By big money, we are talking about the managers such as hedge funds. As an investor, you want to keep an eye out for these guys because with so much capital at their disposal, they can really sway the market. This is especially important if you are a short-term trader or momentum trader, as it's the only one of the few ways that retail investors can track fund managers' activities. 13F filings can be quite a valuable tool. A 13F filing is a mandatory disclosure of an institutional manager's portfolio with over $100 million. It is required every quarter, and the big hedge funds need to submit the 13F filing within 45 days of the reporting period. Once submitted, it is publicly available to be viewed on the SEC website. There are aggregators' websites that help with the analysis of these portfolios. Two websites that I found to be quite useful are dataroma.com and hedgefollow.com. We will get to these in a moment. Now, in the fast-moving world of money, every 3 months plus 45 days to find out information feels like waiting for a sloth to move. And it is. This is the main drawback of trying to copy a fund's positions based on the 13F filing. To add to the delay, most if not all hedge funds will submit their filings as late as possible. This is to prevent the competitors from knowing their plans and strategies. Another drawback of the 13F is that it won't give you any insight into the fund's other strategies such as short positions and arbitrage. Its rules are also subject to change, as evident by SEC's recent proposal for the 13F reform, which suggested increasing the filing threshold from $100 million to a whopping $3.5 billion. This obviously drew enormous opposition, and it was subsequently shelved. In saying so, here are 3 pieces of advice on how to build a strategy around 13F filings. Firstly, look for hedge funds with managers who are long-term stock-picking managers. This will require you to do some research into the fund managers themselves. Things to look out for include, but not limited to, how long they've been with the fund, how many funds they manage, and how often they cycle through their holdings. Like we have mentioned, 13F filings will not include short positions, so if you come across managers who are big on holding stocks, then you can really reduce the risk of unreported positions. Secondly, track larger positions within any given portfolio. A large position is anything above 7.5%. This is because a large position shows that the fund is bullish on the stock and wants to accumulate. It can also show you an insight into what sort of industry they are currently favoring. The inverse to this can serve as a guide when you are looking for a stock that has had a recent sell-off. Hedge funds are more likely to reduce a position if they see no more potential for growth or inside knowledge has tipped them off of a possible downgrade, whether it be revenue, operational effectiveness, or profit. Lastly, look for consensus across multiple funds. It can be a reassurance to see that a stock is being held by multiple funds. It is important, however, to incorporate your own research and analysis to the given stock, because at Wall Street there is this mentality that it is better to be wrong with everyone than being wrong alone. This means multiple funds can purchase a stock even if the stock is going down simply because they can't get into trouble for being wrong when everyone else is doing the same thing. These advice are just that, advice, not rules carved in stone. As I previously mentioned, there are aggregator websites that help to analyze these portfolios. Dataroma.com is simple to use. It lists the stats of the company showing top 10 most owned stock, ownership count, and maximum percentage of portfolio. Personally though, I find hedgefollow.com to be much more useful. The visualization tools really help me to get a bigger picture of these portfolios. In preparation for this video, I went through the top 10 performing funds ranked by their annualized 3-year return. Drilling into the portfolios, we found that the 2 sectors that make up a big portion of these portfolios were technology and consumer services. Technology companies include Square, Uber, and Facebook. Meanwhile, consumer services companies include Disney, Amazon, and Netflix. It is important to also notice that you can classify many of the consumer services companies as technology companies. For example, Netflix. This should not be a big surprise since US markets are tech heavy and technology in business now is basically a must. Companies cannot survive in today's world if they do not leverage the power and cost efficiency of technology and automation. Disney itself is turning to Internet of Things or IoT technology in its theme park operations. Another reason why tech companies are an attractive option is that they are propped up by massive valuations. One notable driver of these incredible and often at times ridiculous valuations is SoftBank's Vision Fund, coupled with unreasonably optimistic investors. SoftBank is the world's biggest technology-focused capital investment fund. The founder of the fund, Masayoshi Son, is a strong advocate for technology startups. With such a huge amount of money flowing into the sector, it is no surprise that hedge funds are piling in to ride the waves. This may be reminiscent of the dot-com bubble where loss-taking tech companies were being massively overvalued. And they were. There is a general consensus that there is a tech bubble. So if we're so self-aware of this trend, why are investors so optimistic about the future? Tech companies these days can be quite adaptive to the macroeconomic environment due to the low overheads of scaling and lower cost to pivot. For example, Zoom, the video conferencing app and company, enjoys huge growth due to the pandemic as businesses shift to working from home. We also have to understand that there is a massive influx of a new generation of investors who are more forward-looking, and as such, technology companies will continue to benefit from these positive outlooks. Meanwhile, consumer services companies are those that provide services to everyday people like you and me. Like we have mentioned, you can reclassify some of these as tech companies such as Netflix and Amazon, but fundamentally, they are consumer services companies that are leveraging the power of technology to deliver their services. Netflix is just an entertainment company that utilizes the internet to deliver its content. Similarly, Amazon is just a marketplace that utilizes the internet to facilitate buying and selling. The term consumer services is quite broad. But broadly speaking, you can break it down to essential and non-essential services. Essential services are those that life cannot function without, regardless of economic conditions, such as transportation, education, and healthcare. Meanwhile, non-essential services are those that you can live without. Although HedgeFollow.com classifies Uber as a technology company, I would classify it as a consumer transportation service that leverages technology to facilitate ride-sharing transportation. Classification like this matters as it helps to understand the business risk and opportunities and how those risks and opportunities are affected by macroeconomic conditions. With the example of Uber, during bad economic conditions, I expect that its operation would decrease as people would opt for cheaper means of transportation such as trains and buses. However, the pandemic has been a mixed bag for Uber. This is reflected in the share price initially when the pandemic broke out. Uber's stock dropped by almost 80%, but since then it has recovered and then some more. In fact, Uber lost less money during the pandemic than before. This could be because people are opting for ride-sharing instead of public transport to minimize the risk of infection. For non-essential services companies, I would expect an entertainment company like Netflix to suffer quite a bit, since entertainment would not be classified as an essential service, and with high unemployment, I expect people to trade their Netflix subscriptions in to put food on the table. However, things seem to work in Netflix's favor. With physical distancing, stay-at-home orders, and stimulus checks, people are at home more with little to do. And Netflix is in a great position to be the escape that people need. Its share price dropped to a low of $254, but only to rebound to $547. These two examples are meant to show that classifications like this should be more fluid, as what may be considered as an essential service decades ago may not be anymore, and vice versa. In conclusion, I'm not saying that I recommend copying the hedge funds based on their 13F filing to a T, but I definitely encourage people to check them out. Reading the 13F filings gave me opportunities to see what the funds were holding last quarter, what the next likely move is, and how I can use that knowledge to adjust my own personal portfolio. And that is pretty much it for today's episode of The Naive Investor. Just want to know your thought. How do you go about in picking a stock? Please leave your answers in the comment section below. We would love to hear it. We hope that you found values in the video. If you did, please like, share, and subscribe to show your support for the channel. Even though it's been very fun to research for episodes, it does take a lot of time. Until next time, stay safe and keep looking for opportunities.